Inflation headlines have faded, but underneath, the pressure is shifting. According to the U.S. Bureau of Labor Statistics, inflation has cooled since its 2022 peak, but new global risks are threatening that progress. Inflation, by definition, is the general increase in prices over time. According to the Federal Reserve, inflation is typically caused by 1. Excess demand, when people spend faster than supply can keep up. 2. Rising costs, like fuel, labor, or raw materials. 3. Monetary expansion, too much money circulating in the economy. 4. External shocks, including war, natural disasters, or trade disruptions. From 2015 to 2019, U.S. inflation stayed close to the Fed's 2% target. According to Federal Reserve data, that stability was driven by strong labor markets and global supply chain efficiency. Beginning in 2020, according to the Congressional Budget Office, massive federal stimulus and pandemic-related disruptions began to push prices upward. Inflation peaked at 9.1% in June 2022, according to BLS reports, the highest in 40 years. In response, the Federal Reserve launched the fastest rate hike since the 1980s. As of May 2025, U.S. consumer price inflation is around 3%, down from its peak. But according to the Fed's latest report, core inflation, which excludes food and energy, remains elevated, especially in services and housing. The federal funds rate remains between 5.25% and 5.5%. The Fed has paused rate hikes but isn't cutting yet. According to Bloomberg and Reuters, new risks are emerging that could reignite inflation. Rising tariffs between the U.S. and China could push up prices of electronics, machinery, and consumer goods. Ongoing conflict between India and Pakistan threatens regional oil supply. Red Sea shipping route instability, as reported by the Financial Times, is causing container delays and fuel cost hikes. Each of these adds to cost-push inflation, where businesses raise prices to absorb rising costs. According to the International Monetary Fund's May 2025 outlook, global inflation is expected to remain volatile, especially in emerging markets and trade-dependent economies. Domestically, Oxford Economics projects that U.S. inflation could remain between 2.5% and 3.5% if energy and wage pressures persist. But if geopolitical tensions ease and productivity rises, inflation could still drift toward the Fed's 2% target by late 2026. According to most economists, the risk isn't hyperinflation, it's instability. Whether inflation stays down or rises again depends on energy markets, global supply chains, and policy discipline. So while things are calmer, this isn't the end of the inflation story. It's just the next chapter. Subscribe now for clear, fact-based updates on inflation, markets, and global trends. No hype, just insight.